Canadian investors are using ZSP over any other ETF for exposure to the S&P 500 index. Institutional investors, investment advisors, and DIY investors have all been trusting ZSP with their investment dollars since the fall of 2012. ETFs provide instant access to a portfolio of stocks to an investor in a single, cost-efficient trade. For an investor to own the entire index would require institutional-level trading systems and expertise. To accomplish this, an investor would have to buy 500 stocks at a time, and then as the market moves, they would constantly have to rebalance those 500 stocks several times a year. ZSP simplifies this process by aiming to provide instant access to the 500 stocks in the index in a very easy and low-cost way. Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to Loonie Hour, episode 157. As always, joined by the three amigos. Boomer, got his Patagonia jacket on. Rich Diaz. How's the art wall? It's growing.
The art wall is growing. But that's not important. What's important is that the Montreal Canadiens beat the Toronto Maple Leafs last night 1-0. We're going to win the Stanley Cup. We've got a goalie. We've got two centers. This is our year. I can feel it. Ça sent la coupe.
This guy's delusional.
And what's the date here? Is it what, October 5th, 9th?
Game
8th?
one. Rich, did you go to the
dear.
home opener?
No, I didn't go to the home opener, but I'm going to go to a bunch of games. Don't worry. I will keep you informed.
All right.
Wow.
1-0. There we
Okay.
go.
There we go. One down, 83 to go. Is that what they play? 84 games?
81 games. We're going to go 82-0 this year. I can feel it.
Okay.
Boomer?
Okay. Yeah, I got nothing new. Absolutely not. The boy is
How the
coming
Mooseheads
home
doing?
from, I don't know. I don't follow the hockey as close
No,
as you
man.
guys do. But Junior is coming home for reading week, I think they call it. You get a break in school. So he's coming home on the weekend for a bit. So it's
Turkey?
exciting to see him. We'll have we'll have a Thanksgiving celebration get together. How about you guys? Do you do that
cooking?
out west? No, Mrs. Icecap does that. I'm not
Not to
allowed.
be trusted in there, eh?
I'm not allowed. Yeah, it's a bit of a not only trust, we got to earn trust with execution. So I haven't been very good at executing some of these things, but I'm really good on the social side. Great
Yeah, you'll be
stories.
sucking back the
Really good
vino on the
stories.
sofa watching the 49ers.
Yeah, it's going to be fun. What about you out west? What's new, Steve?
Not much. Yeah, just a couple family dinners this weekend. So actually we're hosting one of them. So wish me luck.
And what's the meal? What's
I'll put out
the
Put out the cheap wine.
what's the meal going to be?
I don't. That's out of my wheelhouse. You know that.
Okay, now
I'm
we're
not to be
letting everything
trusted.
out here.
Trust is to be earned.
That's
right.
a good point. That's a good point.
A wise man once said.
Yeah. Speaking of trust, are we going to trust the central banks going forward? We'll see. We got that
Well,
today.
That's a little preview. We'll find out.
Yeah.
Did you guys see we had the they're keeping busy over there in Ottawa these days. We had the Minister Freeland come out with a couple more housing policies and suggestions. So you guys remember we talked about it, was it 2 weeks ago when they increased the CMHC insured mortgage limit from $1 million to $1.5 million, which was kind of completely out of the blue, obviously stimulating demand, trying to get developers to basically giving them a lifeline, right? Trying to get people if we can get people borrowing more money, maybe that will help pre-sales and help people close and da 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 da. Well, what they've also done this week is they increased the CMHC limit for people that want to add a basement suite or let's say a laneway house to their property. You can now borrow up to 90% loan to value on a $2 million home. So this is new. Like we had we had this back in the early O's, leading up to the global financial crisis, where you could basically improve your property and and take on a whole bunch of debt. So basically what this is CMHC insured mortgages, so taxpayer insured mortgages. Heath, let's just say you own a property in Halifax. It's worth 1.5 million. You want to add a laneway house because Junior doesn't want to live in the house. He wants some more privacy. So you build a laneway house at the back. That's it. It costs you 400 grand, but you get the bank to appraise it. And the bank says, hey, listen, this thing's worth 2 mil now. So you can then go to CMHC and say, hey, CMHC, I want to refinance my property up to 90% loan to value on what's now a $2 million property because I added a laneway house. And so CMHC will refinance you and basically cut you a check.
With the house as collateral?
Yeah, the house is the collateral, obviously. So the taxpayer funded CMHC just says, well, yeah, the improved value of the property is now 2 million, right? You've built the laneway house. And so we'll lend you 90% of 2 million.
So what does that mean for supply?
I mean, the idea is that the government's thought process is this is going to help people add basement suites. Like if you couldn't afford it, or you know what I mean? Like so
Seems
the idea
like it seems like an Airbnb opportunity, really.
well, they're I don't know. There's stipulations saying you can't have short-term rentals. So I'm assuming there'll be a covenant that goes on title that says you can't.
So in
Airbnb.
my situation, like in my fictional situation here, 1.5 million, I spend 5 to do the add-on, whichever way it's going to
Yeah.
look and feel. Now it's assessed or valued at 2 million. I got the 5 from somewhere, right? To
Yeah,
do
you
the
probably
renovation.
borrowed it on a line of
Or say
credit.
I do
Or
300, say 300,
sure.
right? Okay. Then it increased the value by 5. And now I'm able to borrow at another 1.8 million. Is that what you're saying at the CMHC
Yeah.
insured rate?
Mm-hmm.
Okay, so now I already have 300 I took out from somewhere. And
Yeah, I'm assuming you'd use the 1.8 to pay off the 3 that you borrowed.
okay, let's do that. So now I'm
Because
down
you're
to one.
probably going to go to Equitable Bank is an alternative lender. They just came out with a program that is basically going to help homeowners build these properties, for example, or you'd go to a private lender, or you'd go borrow on a home equity line of credit or some form of line of credit to build this laneway house. And so you basically would use the new money coming from CMHC to pay off the borrowed money to build the project.
So would I just borrow then the full 90% or just enough to cover the 300 to get a lower financing rate overall?
I guess it's up to you, but you could technically refi the whole thing and take CMHC money for 1.8.
But then I still have to have enough household income to pay a monthly mortgage
Yes,
on 1.8,
I suppose. Yeah, I suppose. But you might be
right?
like, well, hey, I'm pulling in an extra $3,000 a month in income now from my laneway house. I don't know. Basically, what long story short is, not to get into all the semantics of it, is I'm a little bit nervous about using taxpayer dollars to fund people adding on to their homes and to take on 90% leverage on a $2 million property that is a lot of leverage.
But isn't this all just a super fiddly kind of like how many people can do? I mean, like, or what are these numbers? Like, how
Okay,
many
so
people
I'll
can
give you an
do this?
example.
Does
So
it move the needle?
that's kind of what I said, truthfully. But I've got other people in the industry that think otherwise, and that's fine. Everyone has their own opinion. I think what you're going to see is some of the more savvy people, like some of the investor crew, which is going to go out there and say, you can go out there, and so it has to be an existing property. But what you can go out there is you can go buy an existing property today, let's say for 1.5 million. So you own it. Let's say you own it, you live in it for 4 or 5 months, and then you apply for that program and say, okay, now I'm going to add a basement suite or a laneway house. Add it, you take out the money, you improve the value, and then maybe you flip it in a year and a half, and you get out
Okay.
and you do it again. So like maybe, I mean, that's the other counter argument. But anyways, long story short, the money is flowing and it's all taxpayer funded. We continue to sort of ramp up those programs. But the
So
one
under
that,
no
yeah,
circumstance are house prices allowed to fall in any way. I mean, that's just more of the same that we're hearing every month or every week, whatever.
I think so. I mean, I think that every indication is that the government is really trying to sort of get the housing market kind of revved back up. Um, I think they're seeing
It's funny
obviously
though, because they want to, you say, rev it back up, but they don't want prices to go lower. So instead, and if they're admitting that, aggregate income won't increase, so therefore they're trying to make it more affordable on the financing side. Is that, I'm connecting the
yeah,
dots, right? Right, Rich?
yeah.
Yeah.
They're trying to make it more affordable by giving you sort of more money to access, and extending amortizations to allow you to afford the payment. And then they're focused on, maintaining they're really concerned about what's happening in the pre-construction market. The supply valve is basically shutting off. So you have a record number of homes under construction today, all-time record high. But so those are being built, but after those are built, the new housing starts are completely shutting off. And so they're really, really worried about that. So they're trying to sort of bring in all these little incentives and programs to keep developers to continue to build. Keith, but there's this funny thing, right? Is these guys are trying to arrest the economic cycle. They're trying to arrest the real. It's
Do you
it's a
mean like
classic
from a criminal, like handcuff arrest, or like a self-arrest in the mountain climbing world?
self-arrest.
And what
Self-arrest.
do we call these people who tried to screw with the business cycle, Keith?
Commies. They're commies.
It's funny, right? Though it's just like you can't. So I'll give you an example. So they've also put a proposal forth for a vacant land tax. This is the kind of the big one. Obviously, it doesn't really matter because it's a proposal. They're now consulting with provincial governments to put a 3% tax on vacant land, because they want to basically say to developers, hey, you can't sit on this empty land. You need to build. If you don't build, you must pay 3% penalty. Doesn't really matter because these guys are going to be out of government in probably the next 6 months. But the just the idea that like this is what they're trying to like, they think this is a good idea. I think really kind of tells you everything that is going on in Ottawa. Is they're just kind of scrambling
Whoa,
for
whoa,
policies.
whoa. Ottawa? I thought we're talking about China. I'm confused.
Some guy,
Come on.
I thought this was all the stimulus that Rich introduced last week. Everything that's happening in China
Okay.
was another add-on. This is Canada.
fun
It's
story.
really
I had a guy on
Thank you
Twitter.
for
He was
that contribution, Keith. Yeah, I just wanted to provide some context because it's amazing as the government is trying to re-lever our system to arrest the business cycle, Keith. And I think it's worth just reminding everybody that household debt to GDP in Canada is basically, if not the third, if it's the fourth highest in the world at 100%. Most of that is mortgage debt. At 75% of that is mortgage debt, 75% of GDP. The only two countries that are ahead of that are Switzerland and Australia. Switzerland is its own animal. Australia also, I would argue, has a housing bubble. And then debt service ratios are at all-time high. And we're going to talk about central banks cutting and the race to zero, but I don't think that central banks, unless they cut to literally zero, and Keith's going to try to convince me that's going to happen, the debt servicing ratios are going to be really, really high. And so I just don't understand. Like, it's not a numerator problem, it's a denominator problem. We need more income, and we need more wealth, not more debt, or we just need less people chasing after fewer goods.
Can I just Yeah, and can I just chime in there just on like the vacant land tax stuff? People will say like, yeah, like if you're not sitting on it, like you got to build, like you can't just sit on that. Like this is like feudalism. You're sitting like people don't
Feudalism?
they don't really understand how development works. And like I get it, like if you're outside the industry, but like it's just infuriating. I mean, so like think about this. If you're like a large Okay, so first of all, why is nobody developing today? Keith,
Uh,
we've run the economy into the ground. We're in a recession in Canada.
that's not what Krista Freeland said. She said the economy is doing really well on her latest tweet.
Right. So the free market has decided they no longer want to own pre-construction units. The investors who have the capital do not want to buy housing. First-time home buyers who have the ability to step in are not filling that void. So a developer that wants to launch a project today that needs to sell 60 to 70% of the units in order to obtain financing from the bank to build the housing is not able to hit their financing requirements. They're not able to pre-sell the units because the demand and the market is not there. So thus it does not get built. You ran the economy into the ground, and now you're saying, well, the solution is we need to penalize them for not building. They are not building because the market is not allowing them to build. The free market is not absorbing the units that are being put to market. These projects are hundreds of millions of dollars that are being deployed. You have general partners, you have limited partners that are capital partners into these projects, and there's a risk reward factor. As anyone that, Keith, manages money knows, like, capital goes to where it seeks the highest return and where it feels safe. And so today people do not want to put their money into Canadian housing, whether that be on the development side or on the pre-construction investment side. So this idea that, well, if we just apply a tax to them, maybe that will get them off the ground. They're not getting off the ground because they're no longer economically viable, and applying a 3% tax is not going to make these projects viable. If you're a large real estate developer in this country or in one of these provinces, you don't just, when you're ready to build a condo tower, you don't just go out tomorrow and buy a piece of land and start building. These things take like 5, 6 years, 7 years of planning. In many cases, it's 3 to 4 years to rezone the dirt, and then another 4 to build the project. So it's like, if you're a large developer, you need to hold inventory. You have to hold inventory of land to be able to readily deploy that land when the market is able to absorb that product. So, I think it's just classic, government coming in with another tax. It doesn't know the industry. People that don't know what they're talking about. Everybody has an opinion. But that's just the reality of the way the construction development world works.
And Steve, is it the feds or the provincial side that wants to charge the empty land tax?
So the feds have put forward a consultation period with all the provincial governments, because I believe, to my understanding, it would be the requirement of each province to implement this. So the feds are kind of leading the charge, the roundtable discussion, saying, hey, what about a 3% vacant land tax? And for whatever reason, people seem to think like nobody out, no, like, what other country has this other than, like, the only one that actually has implemented was Ireland with very little success. That somehow Canada's figured it out. This is the panacea. This is the one that's going to figure it all out.
There's two things I'd like to say, which is to, according to Wikipedia, which is of course never ever wrong, the federal government, including provinces and the crown, own something like 89% of all of the land in Canada. So I think it's important to consider that when we're talking about sort of unused land, or that land that's not deployed, etc. And the other thing is, aren't you going to tell us that, maybe I'm beating you to the punch here, but aren't you going to tell us that rents are also falling? So you're asking people to develop property, develop land in a market. I mean, you mentioned the economy is slowing, but even outside of that, we know that rents are now falling. So how does that square?
I mean, this is why I've also said, like, I said supply and demand, but like, we can't, let's also not pretend that supply is the only single factor that is going to solve Canada's housing woes. Like, this is a multifaceted problem that has been building for several decades. So yes, the reality is when the market turns lower, aka prices start falling, rents start falling, you don't get new supply getting built, because again, you need money, you need capital, you need not just like your own investor money, but you need bank financing. Now, how many banks are like, hey, Mr. Developer, yeah, market's pretty bad, eh? Yeah, prices are down 15% and looks like it's going to get worse. Yes, we'd love to stroke you a check to go and build this $50 million project with our ass on the line, right? So it's like,
is that how the conversation actually goes? Is it at that level?
I was in the room. But people it's just amazing that people, think that economic gravity does not apply. That people like it's a free capital market. And so, yeah, Rich, to your point, we've talked about on the show. I said, hey, shelter inflation. I think that's kind of a lagging component because in real time, every conversation that we're having with our property managements is that rents are declining in real time. And so we now have data from rentals.ca. It's, I think, one of the best rental reports in the country. Their aggregated data is showing that rents in Vancouver on a year over year basis are down 10%. In Toronto, they're down 8%. So rents in Canada's two largest major metros are declining, and they're declining at a pretty significant pace.
But in their defense, the commies, that's what I'm talking about. In the commies' defense, they haven't experienced economic gravity.
Mm-hmm.
So we've talked about this before and quite a bit. There's literally been over a decade without having any economic consequences to any kind of risk taking or true price discovery. And now we're finally getting it. So like I understand why they're trying to do what they're doing. I don't appreciate it. I just think it's going to be ineffective. And at the end of the day, all these moves is simply going to add to or decrease our productivity, something you've talked about quite a bit, Rich. And I mean, the only solution is, and it doesn't sound fair for a lot of people listening, but the economy now has to run its course. We're going to have losses. It will happen. And then, you'll have animal spirits, taking over once again. And then a developer will say, wow, I have better visibility. I can see the opportunity to do this.
Mm-hmm.
I'll take on a bit more risk for it. Private investors, they'll recognize it as well. They're going to say, hey, yeah, you know what? I'm going to cut a check for $2 million of my own money and put it in that local development. And then you get going. But as you get more and more interest, interference, whatever you want to call it, coming from our governments, at both the provincial and federal level as well, and municipal, it really forces private investors, because we don't like to lose money. If it's your money you're going to lose, you're very careful with it. If you're government, it's somebody else's money. No one cares. Like, no one cares. Like, for example, Trudeau said very famously back during the pandemic, he said, we took on the debt so you wouldn't have to. Do you remember that line? And it was not only was it cringeworthy, but it's still like, what are you talking about? It's the debt is still there. Now, here we are 5 years later, and it's still accumulating. So, I love the word that you use, Steve, about economic gravity. I'm going to start using that one, by the way. And I'll say I came up with it.
I thought the same thing. I'm going to steal
it.
It
is a good one, Rich. Do you like that one?
It's a really good one. I'm sad I didn't think about that myself.
Yeah. What do you got? Like, what else do you have?
That's the only creative thing I brought to the show in 3 years. So there you go.
I have a question though. So and I'm a bit confused, right? So, and sorry if we're dwelling on this, but on the one hand, we say there's a housing shortage, and I guess the government anticipates that new supply is falling off, which is why they're introducing these programs to sort of arrest this decline. But then on the other hand, we're seeing house prices fall and rents fall.
Yeah.
And so it's a
good question.
So I can't square that.
Yeah, love it. I mean, I think this. I don't think that you have a housing supply shortage today, given where the demand levels are, which probably going to remain relatively weak over the next 12 months. And you've
sorry, I'm interrupting, but so then how do you square the rents falling and house prices falling?
I don't think you have a supply shortage today. Truthfully, I think you've got a record number of units that are completing right now, that are under construction and completing.
Sorry.
So you've got a record number of units. I think what happens is in these economic downturns, like, you not see it in the data, but like when people have economic uncertainty,
they're
not going to go out there and pay top dollar for a new rental place, right? You might not move. You might just say, yeah, I'm comfortable in my more modest rental unit. I'm not going to go upsize to something nicer and fancier and newer. If wages stop going up, like what they were, again, you can't really pass that through into the rental market. I think as you get into sort of job losses, economic uncertainties, as we saw during the pandemic, household formation actually collapses, right? So people start moving, start moving back home. They would go into the basement at mom and dad's house as opposed to renting a $2,800 a month 1 bedroom in the city of Vancouver. So I think that's kind of what we're seeing is we're seeing, and not only that, I mean, Rich, like, I think what's happening on the immigration side when there's not enough jobs for these people, maybe you just go home. And so I don't know if that's showing up in the data yet, but I think that's probably influencing the rental market. We're certainly seeing it. The conversations I'm having is on the university side, is you're seeing just enrollments down. There's vacancies are up. I'm not sure how much of that is tied into all the changes at the federal level around foreign students, but I think it's a combination of all that. So in the very near term, I don't think you have a shortage of supply. I think you could argue we're oversupplied, right? You've got 8 months of inventory in Greater Vancouver. You got 7 months in the GTA. You've got a lot of inventory. As you start moving further out, so in I think it's 2028, new home completions in the GTA will be like basically zero.
Crazy.
Like basically zero. There will basically be no new homes completed in 2028. Because what's happening today is nobody's launching new supply today. So in 2020, you can actually see the forecast. And in 2028 and 2029, there's like little to zero homes being built.
Crazy.
All
right.
Sowing the
Thank you.
seeds for the next crisis.
Ever been abroad and needed Wi-Fi? Download Saily. Tired of telecom oligopolies ripping you off? Download Saily. Want to avoid sketchy SIM sellers at the airport? Download Saily. Saily might be the only travel app you need. It provides an internet connection wherever you travel and saves you money on roaming fees. It's easy to use, affordable, and reliable all over the world. Saily is the modern, seamless way to get connected without the need for physical SIM cards. With eSIM technology, you can instantly activate service from anywhere in the world. No more waiting in line for a local SIM or dealing with expensive roaming charges. Saily offers flexible plans to fit your needs, whether you're traveling for work or leisure. Plus, you can switch between networks in just a few taps, ensuring you always get the best coverage at the best rates. Whether you're a frequent traveler, an expat, or just someone who wants more flexibility with their phone, Saily's got you covered. No hidden fees, no contracts, just affordable, reliable data wherever you go. Visit Saily.com/Loonie Hour for 15% off.
Keith, that brings me to the next topic of conversation. What we really need to arrest this economic cycle is lower rates.
Yeah.
We need lower rates. We need to get the race to zero is on. And former Bank of Canada Deputy Paul Beaudry is calling for a jumbo rate cut here in October from the Bank of Canada. So he says there's good reasons to move interest rates back to as close as to neutral as quickly as possible. The preconditions were there, kind of starting to move down. You want to move that down quickly. His Twinkie bet, he says, quote, "I would really bet on 50 basis points at the October 23rd meeting." So Paul Beaudry's Twinkie bet is on the line. 50
Did he
basis
literally
points.
say, "I bet"? They used that word?
Yeah, he did. Yeah, it's in a Bloomberg article here. He says, "I would really bet on 50 basis points."
And, from a betting world, it's actually not that brave of a call because the market is calling for 50. So it's not as dramatic as what he's making out to be. But everywhere now I turn, I'm now starting to see the race to zero. It's on. It's alive. Even Rich is saying it too. And he wasn't down with it a few days ago. But let's sort of reset this. Like as little as 3 to 4 weeks ago, we were still waiting for the Fed to cut. They haven't cut yet. And everyone else were kind of doing 25 and a dovish 25. And now literally 3 weeks plus maybe. It's not just, everyone is cutting. It's 50. The jumbo rate cut. It's now acceptable to even talk about it. And no, it's not. It's never happened before in our lifetime unless there was a crisis. But maybe the crisis is happening and, we just can't see it yet. But it is not showing up in any kind of financial markets. And that, of course, though, that's if you believe financial markets are forward-looking, then, by default, they should be doing something. But again, it's just really odd, guys. And everyone now it is literally this race to zero.
Do we have the
When you say
market data?
everyone, oh, sorry, go ahead.
Sorry, I was just curious. Do we have the market data on what is the actual market pricing right now for the October meeting, BOC?
It's almost 50. It's like 43 basis points, 44.
Okay. So
This is on
there's
Thursday. By Friday, you're watching or reading or listening to whatever we're doing here. It's
but
probably at 50 by now.
yeah, so but I mean like if you're Tiff Macklem, like are you gonna sort of upset the market and go 25, or are you just like, hey, listen, market's already priced me for 50 anyways, so
Well, the big thing again, obviously today's we record on Thursdays, you're listening on Friday, and we don't know yet, but I think it is tomorrow morning the Canadian jobs number comes out. Is that right, Rich? It's
Yep.
tomorrow morning?
11th,
Yeah.
yeah.
Yeah. And maybe the data is maybe it's a bad jobs number, the random number generator. You never know what it's going to show in Canada. So maybe it is supportive of only 25, or maybe it puts the nail in the coffin at 50. We'll see then. But again, it's just unusual to everyone's just nonchalantly saying, oh, yeah, we need to do 50. There's enough slack in the economy to do 50. I know, maybe it's just the weird way of doing
But
monetary policy.
I was just gonna say, I mean, like, I don't think that. I mean, I understand what the market is pricing in, and I'll probably get fat eating Twinkies. But the point I'd see is like the Canada's not in a vacuum, and I mean, even if it was, I wouldn't necessarily think it's a good idea to do that. But Canada can't really do that without the Fed. And last week we got really good employment data, 254, well above expectations, which, I think confirms what Keith had said, which is the Fed didn't really cut for itself and the US economy, it did it for outside forces. And then today, sorry to beat you to the punch again, Steve, we have the CPI data and core inflation is starting to creep higher. And you're in a scenario where even if Canada can't just, I don't think Canada can just unilaterally cut its interest rate without having knock-on effects on currency and then that kind of thing. And so I wonder sort of the wisdom of sort of pricing that in a world where the Federal Reserve is actually sort of being kind of called out for maybe a policy mistake and yields are going up, Keith.
That's what's so great, Rich. The Americans, out of the blue, they cut by 50. And, we talked about it, of course, bantered it around, even internally. We had a real interesting day with it as well. And, it was either, hey, they have severe domestic problems in the US that we don't see, but they can see. Or, there's someone else outside, the whole Triffin's dilemma. Do you know that one? The Triffin's dilemma? Yeah. Um, so, and obviously we're getting more and more data coming out now, and none of it justifies the Americans cutting by 50. Because as you said, like the employment number was strong. And granted, some people will suggest, well, it was the last employment number before the election. It sure as hell better been a strong one, because, for some people.
What the market's taken a lot of those Fed cuts out now, right, Rich? I mean, I think at one point, what are they pricing in 6 cuts now? I mean, I think at one point it was 8 or 9.
Yeah, I mean, but that's
yeah, I'll jump in though. But for this year, they were originally had 75 put in, so another 50 and a 25. Now it's 2 25s. So you are right, Steve. It has come back in. Because if they cut by 50 again, and we continue as we are with the American data, which again, like nothing is bad. You could obviously show data to support a bad view if you want to, or support a great view, but there's nothing out to justify doing another 50, so 100 basis points in back-to-back meetings, like without an emergency crisis meeting taking place. So I think that's reasonable, to expect. But here in Canada, we're going to have 50 now coming up in a couple of weeks, another 25 in December. Rich will laugh. Rich, don't listen for the next 10 seconds. The Royal Bank of New Zealand, so the Kiwis Central Bank. Rich likes to dump on New Zealand for some reason. I don't know why, but they are a central bank, but they're not part of the G7, are they?
No, they're not part of the G7.
Yeah, it is a good point. But they did make the news. What the Kiwis did, Steve, they cut by 50. They did 50. The expectations are that they should do another 50 before year end. Citigroup is actually saying they should do 75 by year end. And, back in May, so Loonie hour math, was that 4 months ago? 3, 4, 5, something like that. The central bank itself then, they said, we will not cut rates until at least the second half of 25.
Man, it sounds like a Tiff Macklem call.
Yeah, it does. Absolutely. Yeah, absolutely. So what happened in 3 months, for the Kiwis to go from, hey, we ain't cutting rates for at least another year. So, get ready for it, to what actually we could cut by 100 over the next 3 months.
These guys sound like the BOJ.
Yeah, it's again, it's something weird happening around the world. And it's not something to question it, to say, hey, all these guys are wrong, they shouldn't be doing it. Instead, you should ask yourself or ask your friend and say, hey, they are doing it, right? They're not going to reverse it, but so why are they doing it? If it was just one country doing it, you'd say, okay, they clearly have a challenge taking place. But for the Kiwis to do it, the Canadians, former governors of Bank of Canada start suddenly coming out, and auditioning, to do 50 basis points and all this stuff. The Chinese coming out with all the stimulus measures, government of Canada and out of Ottawa coming up seemingly every week now with a new policy to stimulate housing in some way. If one cannot see that the world is trending lower, grinding tighter and tighter, then I want what you're enjoying, because in the real world here, something funny is happening, which is extraordinarily fun, interesting, exciting in my world, because we're insensitive money managers, we don't care. But I just think that this is going to create some really awkward moments coming up for people who are not following the Loonie hour, because you're getting a heads up from us.
But I mean, that's a difference between, I think, Canada and the US, which is like really fascinating. That the US really did, like, if you look at we didn't talk about the ISM services PMI, which came out higher than expected. Basically, I think it was a 54 or something. I can't remember the exact number, which is a really very decent number. If you look at wage growth in the US, it's okay. If you look at inflation, depending on which one you look at, I know it said a core was going up, but headlines coming off. Productivity's back up. Real wages are at 2%, which is really strong. I mean, there's creaks and et cetera in sort of the delinquency ratios for people, but consumption and GDP growth, we know it's been okay. Whereas Canada, all of those factors are sort of the opposite, which is, credit growth is shrinking, we're losing jobs at a faster rate, productivity is very, very poor, wage growth is decent, you know what I mean? And so I think it's just amazing to me you're right, Keith. It's in sync, but I don't understand why, and maybe it shouldn't be, I would say. I mean, that's what I think is a really fascinating piece about this whole thing.
I think what's happening is, I know what's happening. And again, we can be funny about it if we want to, but we literally had this decade where the economy was not allowed to do what it was supposed to do. An economy is supposed to reward correct risk taking, and then you should get punished or unrewarded for making bad investments, and bad risk. And none of that happened. Now, all of a sudden, that genie is out of the bottle, and it's starting to come on very quickly. Like here's a quote. Try to tell me which country this is from. Okay. The economy has stalled, unemployment is increasing, and house prices are starting to decline.
Canada?
Who do you think it is? It could
Canada?
be, but not from this article. It's from somebody else. Steve, any?
Ice cap?
What a country.
It's
Germany,
Rich's favorite company.
China.
We're still back in New Zealand here. So, but again, you couldn't immediately say, oh yeah, that's definitely New Zealand. Or it can be any one of these countries now. And so I think, I'm not a believer that policymakers can control the economic cycle. That's what Keynesian economic theory is.
I mean, they can't arrest gravity.
They can't arrest gravity. Self-arrest. You know, mountain climbing lore, it's self-arrest, self-arrest, self-arrest. So, you yell it out and you try to, you jump on your axe and you try to, come to an abrupt stop. But that's if you believe that policymakers can prevent a sharp economic decline or continue with an acceleration in the economy, then hey, you guys should be happy. Because when central banks are doing 25s and 50s and maybe even a 75 for down under to the east, right? Is that how you get New Zealand? Something like that.
Something like that.
Something like that. The Lord of the Rings area. Yeah, then you should be happy because, hey, the economy should bottom very quickly and then we'll take off again, to the races. If you're a realist, you should know that, no, we're going to have some losses coming up and the losses will be in the loan markets and everything.
But where are the real, like, Rich, where are the actual, like, landmines? I mean, we've talked about, like, if the US isn't that bad, Canada's so small. I'm assuming, like, we're doing these jumbo cuts because China's in real trouble. Germany looks horrible.
Yeah, I mean, there's just like it's just a weird situation, and I think this is sort of we've talked about this before, where lots of different data, it's like fraying at the edges, which is to say, there's loads of data that's sort of contradictory. We talk about one way to like measure it is if there's any kind of issues with, let's say, corporate credit is credit spreads. Well, credit spreads are as tight as ever, and the function of that is because non-financial corporations were able to refinance at such low rates. We talk about profits. I'm of the view that markets generally track earnings. Keith disagrees, and that's fair enough. But earnings have actually been okay. Margins have actually really, really held up for the larger companies. And those large companies in America employ a disproportionate number of people. Unlike in Canada, where you have the big mega cap companies employ literally tens of millions of people, and then you've got very, very small companies. It's different in Canada. The distribution is different, and so those profits are okay and the margins are okay, and you sort of got no sort of creaks and cracks there. In Europe, Germany is committing ritual suicide with their environmental policy, and they're also getting killed by China and their ability to manufacture cars cheaply and electric cars very, very cheaply. And whether they subsidize that industry or not is a different conversation. But I think there's lots of cracks. But I think the problem is that, the more that the Fed provides liquidity, I think, Keith, I disagree with Keith in one sense. It's like, yeah, I don't think the Fed can stop a business cycle. But I think that the Fed and providing liquidity can delay the inevitable. And I think that in a sense, that's where we agree. And so we will eventually get there. But if they cut interest rates in the United States by 300 basis points tomorrow, I think you just delay that business cycle from, I think you delay that eventuality. And I think that that's what they're trying to do now. But I agree with Keith in the sense we will hit that wall. It just might take a little bit longer if they keep adding liquidity to the system.
I think though what might be happening again, like this bizarre 3-4 week period where everyone is, hey, yeah, 50 is fine, 75 for Rich's favorite central bank, and all that. Maybe once we get through a month of two of more data coming out, maybe this will calm down again. So all of a sudden it's no longer 50; it'll just get back into the 25-point cuts. And that is more, that should be better received by the world than these 50s. Because again, that the 50s should scare the crap out of you. It really should. Speaking of the crap, look at RBC and I love that. I used to work there a long time ago, so I can say that. But I bring that up with RBC. So right now the market is forecasting a 50-point cut in October and then 25 in December. RBC, they've come out and they said, no, we're expecting 50 in the October and December meeting. So they're very aggressive with this call. So maybe, we will see. Maybe they have to temper this and it'll come back to where the market is, or the market will catch up. But again, if Canada's doing 50 this meeting and then another 50 at year end. And the biggest bank in the land, they're the first to come out with, because they have better visibility than anyone. RBC does because of their lending and their business activities. Again, it's not exactly a great outlook for the Canadian economy going into year end and starting in 25.
There's another angle to all this, which we haven't talked about, which is actually the bond market is sort of kicking back at these cuts. And I think that that's sort of the interesting thing. So since the Fed cut, I believe that interest rates are actually up, if I'm not mistaken, right, boys? It's like, it's
long term.
Sorry,
non overnight, I guess.
Yeah. Sorry. I mean, the long end of the curve is actually starting to pitch higher. The theory is the long end of the curve includes some measure of GDP growth, inflation, and some kind of term premium. And it's interesting to see that, it's sort of rejecting this idea that, maybe the recession in the US is coming or inflation is going to go down. And that brings us to the CPI stuff. It's sort of all muddled. I think I kind of knew what was going on about 6 months ago. And I think that these central banks, Keith, as you say, reacting so abruptly to relatively sort of benign data has really kind of screwed me up on what I think about risk assets and bond yields and that kind of thing.
Yeah, with lots going on in that bond market, though. I mean, this is kind of what we touched on a week ago, Rich, which was how much of this sort of yield curve had priced in aggressive easing, and then obviously you're getting data that's really, again, not that bad. You're getting oil prices higher, and now yields are backing up. And I just look at this from the Canadian mortgage perspective because I think a lot of people saw rates coming down. Like, we had 5 years at one point, almost kind of like 3.99, 4.1, and they've pushed back up 20, 25, 30 basis points over the last 10 days or so.
I mean, there's another element to this we haven't talked about, which is the idea that the inflation might, rear its ugly head again. And the reason people say, how can you say that? Well, I mean, I've mentioned services. I understand in Canada, it's one thing. I know rents are falling, et cetera. But we're starting to see commodity prices just continue to rise. And so we've talked about goods and services, and that goods inflation has been a main drag of headline and core inflation. And we, I've made this analogy before when, the water goes out and hits the edge of the pool and then it comes back. Well, that can happen in reverse in the sense that we've had all of this decline and all those base effects have sort of worn off. And, I know that that's happening in the US where you're having, core commodities actually are, that year-on-year change has basically stopped falling and is now rising. And so in a world where, in the US, you have decent wage growth, you have like okay labor market and all these, and then now all of a sudden you have this, that wave coming back in terms of core goods. And if that's positive, you have a situation where I think the bond market, as you pointed out, Steve, might actually start to price that in and say, actually, we think that this is a policy mistake because inflation's higher and so the yields go up and we don't get that reprieve from lower mortgage rates, which we need for debt servicing, and sort of round and round it goes. I get it, but I just think it's really, really interesting what's going on in that core services and the commodity space. And I think that that's also related to those yield curves. And that's why I think it's before we start pricing in all these cuts going forward, I think we should really, really keep an eye on energy prices. We didn't even talk about oil, but core goods in general and how that's going to affect the bond market.
So I've got a question on this, and I'm not sure if you guys can answer it. I know like the, financial regulators, and you can't really give investment advice, but just in general, how does one sort of like position in this market? Like, is this an environment where, because it feels like it's so uncertain, there's not a lot of clear direction from like where we're going. I think there's an array of outcomes here. Is this a situation where you want to have a larger cash buffer and you want to wait for like that right pitch, for the real opportunity? Like, yeah, it's just, I think a lot of, just looking at feedback from our viewers and stuff, and I think there's just, a lot of general confusion about what to do.
Well, you should always stay invested, never make any changes. If anything bad happens, no one saw it coming, and just hang in there for the long run, and you'll be fine. Right?
Don't mind the 30% drawdown.
No comment.
like one side of it though, there's always something going to be happening in the world with markets, whether it's the stock market or something else where, you always have a reason to be worried, and that's fine. That's legitimate. And, I like to say if you're invested in the stock market, you're whether you realize it or not, you've automatically signed up for an experience where you can make 50% in 1 year or lose 50% in 1 year. If either one happened, you should say, okay, yeah, this is what might happen. Um, I think though, if you are objective right now, looking at all markets, and here's the challenge, Steve. Like when people say markets, they always think the stock market,
Yeah.
but you also have to look at commodity markets. And in the commodity world, you have precious metals, you have base metals, you have soft commodities, and the energy market. It's all four different worlds. There's real estate as well, of course. You have sovereign debt, corporate credit, the currency world. There's lots of markets, and each market is going to be affected by the other one. So I'm not trying to make a complicated, drawn out answer for what people should do, because obviously we're not going to tell people what they should do on a podcast. But for us, we happen to think there's an increased probability of some significant risk off events taking place. And that doesn't mean it has to be the stock market. It could be elsewhere. And it could have a pretty big effect on other markets. And that gets us excited because, again, like we're insensitive about money. And so we look at it as, hey, like this, if you think about it, if you go back over the last few decades and you're looking at markets, this is the only point in time when everything is moving in the same direction at the same time, whether it's policy decisions, the economy, the stock market or another market. And you have to say to yourself, has this ever happened before? And I would argue, no, it hasn't. Not for everyone to be, synchronized. So therefore, it should get your attention, and therefore you should do something to either benefit from it, protect yourself, or something else. Again, this is, guys, like when we get the historians years from now writing they're rewriting history again. I think we're going to look back on this period with one of these, hey, why didn't everyone see this happening? Why didn't you see it coming? So I think that's what we're looking at here.
As someone who studies a lot of history, everyone always thinks they're living in an interesting time, and the vast majority of time is not interesting. So I push back on that view, only from like a historian perspective. Although I do think this is an interesting time from a financial market point of view, Keith, which is fair enough. But
Yeah,
I think the
because
other thing, sorry.
yeah, because from a financial market perspective, remember we had that 10-year period with zero rates, QE, and negative rates, everything. No one ever had a loss. And then the pandemic hit. No one was allowed to work. Everyone got paid. Rates were at zero. You were told to borrow and borrow, and all of a sudden you were told, "Oh, wait, we made a mistake here. Yeah, inflation is now crazy for some weird reason." And it's not a weird reason, guys. If you shut down global production, the supply of stuff just falls. And you go from 0 to 5, and now all of a sudden you're trying to go from 5 back to 0 again. This is extraordinary. It is an historical moment. And I think this stuff is easy to see. I really do. What do you hear about that, Steve?
I was just going to say that just to answer sort of one more thing that people need to know is that, none of this is really priced in. And that could be for better or for worse. But the S&P 500 is an all-time highs. I mentioned credit spreads earlier. They're basically lows. The bond market is, 4 or 5%. That's not screaming one way or the other. And so I think that, we talked about complacency a while back, and I think we sort of moved away from that view, Keith. And maybe we should sort of, rekindle that fire, because I think none of these, nothing's really telling you that we're going into any trouble.
I think that was a pretty good place to wrap it up. Boomer, do you have any final thoughts?
No, I think when Richard said quite a, rekindle the fire, that sounds like a love quote to me. And I think the Loonie Hour fire is going pretty warm here. It's
I hope
good.
so.
And yeah, another really good conversation. So, see, why don't you just sum up the episode? I mean, I think it was pretty easy today on the real estate side, and then the race to zero.
Confusion. This week's Word is confusion.
No, this week's word is economic gravity.
Economic gravity and confusion from policymakers. They're confused about economic gravity. There we go. As always, guys, appreciate the support. Thanks for tuning in, and we'll see you next week.